What's up, gang? Today we're going to dive into another type of patterns, candlestick patterns. If you've been trading for a while, you probably know these popular ones. And you've surely heard that if a bearish engulfing pattern forms, the price is likely to go down. Here, it worked perfectly. But let's look at other instances. Here, the pattern formed, but the price stayed the same. And here, it even went in the opposite direction. It's crucial not only to follow visual signals, but also to understand the context. In this video, I'll teach you how to see the real market situation behind the patterns.
Let's go! Let's go.
First, a very important preface. How should you to consider everything I'm going to tell you in today's video? Candlestick patterns are not a basis for opening a trade. You can observe many of them on charts where they won't work out. Candlestick patterns provide much less useful information than chart patterns. Consider these patterns as an additional plus to confirm a trade. But if the other components of your strategy indicate an opposite price movement, don't let candlestick patterns confuse you. If you're new to trading, here are all the components of a candle. The start of the body is the opening price. The top of the shadow is the maximum value. The bottom of the shadow is the minimum value. The end of the body is the closing price. A candle is formed over a certain period, the time frame you've chosen. When analyzing a chart, I don't focus on patterns, but on the reasons behind their formation. Remembering the names of the patterns is not necessary. It's much more important to understand why these patterns occur and what they signify. Names are just labels that help us discuss these patterns. Write in the comments the funniest pattern names you've come across. Let's break down the most common ones and what they specifically indicate. The engulfing pattern occurs when one candle completely engulfs the previous one. There are two types of this pattern: bullish engulfing and bearish engulfing. Engulfing indicates that bears or bulls have taken control of the market after a period of buying or selling, respectively. Look for engulfing at support or resistance levels. Engulfing is useful in strategies for reversing a local trend. For example, there was a downward local trend, an engulfing pattern formed, signaling the end of a pullback and the continuation of the global trend. The momentum pattern represents a large candle, showing strong price movement in one direction. If you see a large candle, it can signal the beginning of a strong momentum movement, indicating that volatility has transitioned from low to high. For example, in breakout strategies, this is a signal to open a trade. A practical example, in the triangle strategy, breaking the line with a large candle is a signal to open a trade. However, don't confuse this with a reaction to news. If the candle appeared due to a news event, the subsequent pullback could change the trend. The multiple pattern is formed by several candles indicating the same direction. This could be a series of bullish or bearish candles confirming the trend. If you see a sequence of candles moving in one direction, it's a signal for further confident movement. The hammer pattern. This pattern forms after a downtrend, and its shadow shows that the price attempted to go down during one candle but was pushed up by the close. As a result, a candle with a long lower shadow and a small body forms, which predicts a reversal of the movement. The opposite of the hammer, shooting star pattern. This pattern forms after an uptrend and shows that the price tried to rise during one candle but was pushed down by the close. This also indicates a change in direction. For example, in the double impulse strategy, it will be an additional confirmation that the second impulse is over and a pullback is about to begin. The doji pattern forms when the opening and closing prices are almost the same, creating a candle with a small body and long shadows. A word of caution. This is a sign that you should wait. A doji indicates market indecision. In any case, I recommend skipping this situation and waiting for active price movement. Another important point in candle analysis. On lower time frames, price movements are more chaotic. The market is too noisy, and patterns may be random visualizations of market movements or spreads that look like patterns but are not. When we look at 5-minute or longer time frames, we can see clearer and more stable trends indicating where the market is heading in the near future, allowing us to make more informed decisions. Wow, you made it to this point. I'm glad the video captivated you so much. Let's summarize. The main takeaway I want you to remember: context is more important than the pattern. Don't blindly rely on visual signals. Always analyze the market comprehensively, considering support and resistance levels, market sentiment, and other factors, and most importantly, approach trading thoughtfully and with understanding. Stay safe and be in touch.